That's the closing bell on Wall Street, and now it's market domination overtime. Jared Blicker going to be along in a moment to get us up to speed on the action from today's session. Let's start with where the major averages ended the day. And we should note, first of all, that we are moments away from expected comments from President Trump giving some kind of details about auto tariffs. We don't know what those tariffs will be. We don't know who they will affect. We don't know if there will be any exemptions, but we did see the anticipation of these headlines affecting stocks today. So that's when we really started to see deteriorations, when we started to get some reporting that these tariffs were going to be coming, or announcement was going to be coming. The Dow down 134 points here, off about 1/3%, near the lows of the session. The S&P 500 down 1.1%, and the Nasdaq down about 2%. Ironically, today, the worst selling, not necessarily in the automakers, but in the sort of higher growth beta names, higher risk names that we tend to watch, i.e. large cap tech. I know Jared has been watching all this very carefully as well. He is on the floor of the New York Stock Exchange. What do you got, Jared?
Well, I think it's important that we back up a little bit and just kind of review what's happened recently, because we're facing some headline risk today. So let's go to the Wi-Fi Interactive, and specifically I'm looking at the S&P 500. I need to put a candlestick chart on, and I'm going to show since the beginning of the year. That's the year to date. I'm going to put on the 200-day moving average. We just closed above that 2 days ago on Monday. That was a technical signal, not an all clear, but it was a signal for some of the bulls to get long again or to add some risk. But then we stalled out the very next day, right above that level, and that was a January lows. And so what that's telling me is this might have been a little bit of a bull trap. That was just waiting there to happen. Almost didn't matter what the bearish news was today. This is the realization of that. So let's go to the VIX. I want to plot that because that shot up just a little bit, not a whole amount, but that is probably the biggest increase that we're looking at since March 10th, since March 13th. That's going to be some of these movements that we saw up here. And by the way, this is the worst day for the S&P 500 since those lows, since that March 13th low that actually kicked off this little bit of a rally that we're trying to cling on to here. So let's take a look at the sector action and see what spilled here. We are seeing defensive sectors leading, so that is really not bullish. Staples is up 1.56%. Then you have utilities, then you have energy, real estate, materials, all in the green. Not all of those are defensive, but it's kind of a defensive setup in net. And then tech just took it to the downside, down 2.24%. Consumer discretionary similarly down. Those were the underperformers, so those did worse than the S&P 500. But in third place here, we got communication services, and we're going to see how this affected the Nasdaq 100, which you can see on your screen right now. Nvidia down 5%, so is Tesla. Broadcom almost there, Alphabet down 3%. That's kind of a nasty looking board again. And this is the 9th day of the rally that I was talking about just before. Here is the 9-day totals. So you're still seeing some green, actually a lot of green there. So it's not the end of the rally, but we do have something to prove here. So I will send it back to you guys.
Thank you, Jared. Markets struggling to hold on to prior gains while tariff pressures mount as investors turn up the dials on risk metrics. Our next guest says there is a base for concern. RBC Capital Markets equity derivative strategist Amy Wu Silverman joined us now to discuss. Amy, it is, as always, great to see you on the show. Here's my favorite part of your note, Amy. I love this part of the note. You say, our concern for this market, have we moved from a paddling duck market to a lobster in a pot market, Amy? So paddling duck, maybe went to lobster in a pot. Explain to us, Amy, what this means.
Yeah, clearly I like my animal analogies, but up until the beginning of this year, the idea that we were in a paddling duck market kind of fit, right? We were calm and steady on the surface. We did get those violent rotations, but they were kind of underneath. And the issue right now is, yes, we've had a sell-off. Yes, we've had this march higher in volatility. But the word I keep hearing traders use is that it's been incredibly orderly. And I don't disagree with that. But my question is, are we slowly turning up the temperature? And yes, that's orderly. But at some point, we're going to look at that lobster and he's been cooked. And that's just my sense of how we think about these risk metrics slowly marching up. We haven't had these convex gap down situations, but that doesn't mean your baseline year-on-year volatility metrics aren't getting higher and higher.
And Amy, what are those kind of signals that you're looking for that maybe we're getting close to that boiling point?
Yeah, to me, it's not just about where the headline VIX is. That's still sort of sub that psychological 20 level. It's a couple different things, Julie. It's your volatility of VIX. So your VVIX is important. If that starts to pick up, that's something that we should start to get a little worried about. The other is this idea of actual tails. I like looking at the TDEX, which thinks about essentially if there's a 3 standard deviation drawdown in the market, what's the cost of protecting that? That again, that looks relatively sanguine right now, but if these really left tail situations start to pick up, particularly, very difficult to predict with the headline risk, I would start to think that perhaps we're getting closer to that boiling point for that poor lobster.
Short term, Amy, I'm just curious. Let's say, tariff speed expectations today when Trump is going to address us from the Oval Office. And then, of course, let's say they beat expectations on April 2nd. That's the big date we've had on our calendars, right, as investors for a while now. That's Liberation Day, as the president talks about it, reciprocal tariffs. Are we positioned here for a short-term bounce, Amy, if that were to happen?
I do think we are. And I actually spoke about that in the notes as well, in the sense that, look, I think you can have a trend that is sort of driving more downward and have these kind of pockets of small rallies, in particular when you get a flush out in positioning. So, we're not really seeing overwhelming call buying, but I wouldn't be surprised just given the flush out in the markets. Hedges have worked. You passed that big March options expiry time. If things come in better than expectations, sure, short term you can get that. But again, your overall trajectory, very similar to 2022, is that the overall path is still, unfortunately, quite negative.
I want to ask about some specific paths also, Amy, because we've been watching NVIDIA, for example, really closely here. And as our Jared Blickery just showed, it's been down over the past couple weeks of trading here. We keep getting, yes, some headlines, but it also feels like there's some bigger unease or maybe technicals at work here. I'm curious what you're seeing in that name.
Yeah, this is a name where there's certainly fundamentals at work, and a lot of that was kicked off by DeepSeek. But there's a lot of, I think, positioning framework around this because, I think back to our own conversations maybe a couple months ago, and this was a name where you had this concept we call skew inversion. But all that really means is the call demand in this name was so overwhelming that it was actually making it outweigh put demand. That's very unusual in its stock. It really speaks to the FOMO and the momentum in the market. And so you came into 2025 with a name that was incredibly overowned. And as valuations kind of get nosebleed, as you get these larger tariff and policy concerns, it doesn't surprise me, that those people who are jumping in the pool are either hedging or saying, perhaps, we take some of these profits and run.
Another name, listen, we talk about a lot here, Amy, would be Tesla, finished in the red today. Though we had a financial analyst who covers the name on the show. Amy still bulled up on Tesla, sees green shoots ahead. You look at that name. What do you see in Elon Musk's company?
Yeah, it's tricky because I feel like this, all these names we have been speaking to has a very large retail fan base. And in particular, I remember thinking about Tesla in the past as almost its own silo in a bucket of names because, it had just this enthusiastic crowd that was going to buy the dip in the name. We have not seen that much of that. And I think because Elon Musk himself is in these policy crosshairs, I think you've seen that for the company as well. And, wherever you speak in terms of the policy spectrum, the issue is it's very difficult to price. And that's, I think, what we're getting to is, how do you numerically put a risk metric on the idea that he, as kind of a key man risk, is in the policy crosshairs right now? It's very difficult to value that.
Amy, always great to catch up with you. Thank you.
Thank you.
Well, copper prices rising to a record amid a potential timeline shift for tariffs on that industrial metal. Levies on copper imports could be coming within several weeks instead of months. That's according to reporting from Bloomberg. For more on the changing copper market, let's get to Steve Schofstall. He is Director of ETF Product Management at Sprott Asset Management, which has a number of metal-related ETFs. Steve, thank you so much for being here. So we've already seen copper climb quite a bit this year, perhaps partly in anticipation of tariffs coming into place. But how are you thinking about the timing and how that's going to be affecting pricing?
Yeah, it's great to be here. It's a great question. When we start to look at the copper market, we tend to take a longer term view. What we really see with kind of the short term noise that we're seeing with tariffs is a lot of uncertainty. And in many cases, that uncertainty tends to be worse than bad news. But that's causing some fluctuations within the market. What we see is metal prices here in the United States are significantly higher than what we're seeing in other parts of the globe. That's causing metal to be sent to the U.S. ahead of tariff, which sounds like they're going to come out much earlier than many had anticipated on copper. And in some cases, we see manufacturers are actually stepping up their purchases to try to get ahead of future tariffs. So from a short-term perspective, it's adding some volatility. We've seen spot prices rise about 17% so far year to date. And I think as we get some more clarity, hopefully in the next several days about copper imports, or copper tariffs rather, we could see volatility come down a little bit.
Steve, I'm curious, tariffs, one reason. I'm just curious to hear what you think China and its role could be playing here too, just in terms of the incentives to boost the economy over there.
Yeah, so copper's actually undergone a fundamental shift, and it looks a lot different than it did 10 or 15 years ago. Back then, it was considered a bellwether for global economic growth. Things like the energy transition, technological innovation, rising standards of living in developing countries are all contributing to a structural supply deficit, in our view, in the coming years, and actually out through this foreseeable future. When you start to think of the energy transition in particular, it provides a certain level of base investment and spending that really goes a long way and help support copper prices in those downturns and those down markets. Just to give you an idea, it took about 18 years for the average or the annual investment of the energy transition to reach about $1 trillion. It's actually reached $2 trillion now annually, just within 3 years after that. So we're seeing an acceleration in the energy transition and would expect that to be supportive of prices through troubling economic times.
So in other words, Steve, we used to talk about Dr. Copper all the time, that it had a PhD in economics because it was a good measure of what was going on in the underlying economy. It sounds like we should get rid of the doctor, not talk about it. I mean, do we need to just rethink here that it is not as vulnerable to economic cycles as it once was? Is that what you're saying?
Yeah, I think to a certain extent that's right. The global economic health does play an important role in copper, and I think there's still a shift in the mindset of many investors that still view it as Dr. Copper. But the increased investment that we're seeing on the energy transition, we see it on the artificial intelligence space and the data centers, urbanization, industrialization, all those types of projects require massive amounts of copper. And if you go back throughout history, if we go back to about the 1930s, the demand for copper actually increases, doubles actually about every 25 years or so. And we're seeing that play out and would expect the copper market to move into a supply deficit here in the next year or so and continue for the foreseeable future.
Steve, we've been talking about the metal. What about the miners, Steve? How well positioned are those copper miners right now?
Yeah, so these increase in prices that we're seeing, whether it's tariff related or structural and fundamental, which we see in our view, are generally well positioned. When we look at those miners that are pure play, and we think of those as companies that have at least 50% of their revenue or assets tied to mining copper, they have an all-in sustaining cost of mining about $2.41 a pound. If you look at where we're at today with copper prices, we're closer to $4.60 a pound. So there's significant margin that's being built in based on today's prices. And I think one thing that often gets lost in investing in copper miners is if you look at the 10 largest producers of copper, only 4 of those are majority copper producers and publicly traded. So that's really where our focus is, on those pure play miners. And we think they'll be well positioned as we move through kind of this next stage of the commodity bull market in copper in general.
Steve, great to have you on the show today. Thanks so much for your time.
Thanks for having me.
Stick around. Much more Market Domination Overtime coming right up. Markets under pressure as tariff headlines weigh on investors. Our next guest says it's how you ride this volatility that matters, not just the destination. Joining us now is Arneem Holzer, Easterly EAB Risk Solutions Global Macro Strategist. Arneem, great to see you.
Thanks for having me.
So tariffs were obviously goes front and center, right? Again, we have just a lot of noise in the markets. And I'm curious, Arneem, you're talking to clients. How are you talking them through that? What are you telling them in terms of how to navigate this, to look through it, focus on the bigger picture?
Well, first of all, thanks for having me. The main point is it's not about levels. It's not about using traditional techniques and diversification. It's really about adding what the market's telling you should add, which right now is putting volatility into your portfolios, really using strategies that allow you to use this volatility on behalf of your portfolios and resiliency. There are a lot of strategists that are saying, look, take your time, don't worry. In the end, the market, is going to give you that 6 to 8 and you're going to be fine. But the problem is most investors can't wait it out. And when you get a 3 to 5% downdraft with this kind of bad news or potentially, fearful news, a lot of investors kind of lose confidence. And so when we talk to advisors, we're basically saying you don't have to be subject to that. You can make the ride a smoother ride. You can actually improve the resiliency of portfolios while you're doing it.
So do you just sort of go long volatility, in other words, and what are some of the best ways to do that?
Well, there are institutions that we work with that will take those kind of positions. But for example, on the fund that we manage, what we're doing is taking advantage of the range. And there's a pretty strong range trading approach that you can take to really over-defend downside and then make money as the market comes back and vol comes down. So you're really taking advantage of those oscillations. And if you look at the last 2 years, there's actually been a lot of oscillations, even in the up market. And so when the market tells you who it is, believe it. And that's what the market's been saying. And recently, with this unorthodox president, not that it's necessarily ineffective or effective, but he's unorthodox, we think there's a lot of oscillation around volatility that you can take advantage of and use for your benefit.
Arnie, when you are talking to those advisors right now and these institutions, what's top of mind for them in terms of concerns? What do you hear the most?
Well, the first thing they tell me is that they spend a lot of their time speaking to their clients, sometimes on Saturday and Sunday nights. Their clients, even with what you would...
Because they're that nervous?
Because they are nervous, and because the news, the macro news, would connote potentially bigger vol moves, would connote bigger correlation moves, and they've actually been slightly lower than the news would connote. So the markets goes down, up to, let's say, 6-7% from the peak, which is a 2 standard deviation move. It's not a 3-4 standard deviation move, but the macro environment, the geopolitical environment, they kind of connote, they have the potential for bigger moves. Listen, we're 1 tweet away from a 2 or 3% move either direction. And I think the market knows that, even though the statistics would say, hey, we're not really acting that volatile, there is a concern. And so advisors and even institutions are looking at this and saying, look, we've had great run. Do we, should we take some chips off the table? How do we handle that? And most are not prepared to use the kind of volatility tools that allow them to get that resiliency. And so those are the conversations we have with advisors, because you don't want clients to sell out in what could be, in the medium to longer term, a good market. You don't want them to lose and access to that return.
Why do you think the volatility hasn't been more?
Well, there's a lot of questions around that. There's some impact of 1-2-0 data expiry options trading. There's clearly a lot of positioning. There's also some attraction to the U.S. market that has a tendency to keep the flows. There's a lot of liquidity coming out of the post-pandemic, both fiscal and monetary priming. So the levels of liquidity are relatively high. If you look at high yield spreads, for example, they got down to about 250, 260 over. They've moved back up to about 300 over treasuries. But that's still very tight given some of the macro concerns that we have, which says to me there's just a lot of liquidity. And so that has a tendency, liquidity has a tendency to mute vol. Again, if you see some changes to the dollar, if you see some changes to the tariff and trade environment, some of that liquidity could change. And I think that connotes a bigger swings in volatility.
Here's another theme I've heard. I'm curious, as a longtime market watcher, to get your take. U.S. exceptionalism is dead. Your reaction to that?
I love those. I love those memes. Because
I thought you might, Arnie.
I love those memes because honestly, that's like saying that the dollar has lost its reserve status. U.S. exceptionalism is still very, very strong. There are incremental, dents in the armor, but the exceptionalism is still very strong. To believe that the European and the Chinese performance we've seen on a year-to-date basis is a portender of an evaporation of U.S. excellence, I think is a little overly optimistic. And in fact, the earnings don't really show it. You still have problems in China with regards to their the real fiscal stimulus that they're going to put through. Will it be enough? It's not clear to me. European earnings are running at like half of S&P projected earnings and 65% of 1 year plus 1 earnings. So yes, they're lower PE, but they're also lower ROI, and they're also lower in terms of the expected earnings. So I think the case you have to make also is if the U.S. catches a cold, it's never better for the rest of the world. And even when the U.S. is the source of the problem, the US outperforms. So I think you have to be very careful when you look at those kind of cases, those kind of memes.
When you're looking, I mean, you are very focused on this volatility picture.
Yeah.
How long do you think it's going to last like this? Or put another way, what would decrease the volatility?
Well, we did see the better performance helped, but there's still issues around what is the Fed going to be able to get to. I think the Fed is still very core to this issue because the what if wonky our star discussions around where is the equilibrium rate. My sense is that the equilibrium rate of inflation, the equilibrium rate of yields is actually slightly higher than pre-pandemic. There's a lot of reasons, it's too long to go through here, but there are a lot of reasons that legitimize slightly higher yields. So what that means is the amount that the Fed can really ease, even if they want to ease, is going to be more constrained. You see that even 2 this year is going to be kind of a difficult task. And I think Powell correctly stated, this may be transitory, but the Fed has still got a relatively high inflation target. So against a lower GDP target. So they're telling you, there's not so much easing still to play. That tells me that vol is probably going to be elevated because the levels of vol long term and the levels of yields kind of do mirror each other. If you saw a reason that inflation was going to go back to pre-pandemic levels in a credible way, I think you could see the level of vol go back down into that 8 to 12 range. But as long as that's not the case, we're thinking this 15, 16 to 20 range is a real tradable range.
Arnim, great to have you on set today.
Thank you.
Thanks for joining us.
Thank you.
Starting off on the earnings front, we're going to be getting a couple of reports from Winnebago in the morning and Lululemon. That's coming up after closing bell. Lululemon announcing results for the fourth quarter. Analysts anticipating stronger sales in Q4, driven by better product choices during a strong holiday shopping season.
We're watching for another round of Fed commentary coming tomorrow afternoon from Fed President Susan Collins and Tom Barkin. It is coming after comments earlier today from St. Louis Fed President Alberto Musalem, saying that the inflation impact from tariffs may not be temporary and cautioning that secondary effects could prompt officials to hold interest rates steady for longer.
And moving over to housing, some fresh housing data is coming out in the morning with pending home sales. Economists forecasting a small rebound of 1% in February on a month-over-month basis.
And sticking with housing, weekly mortgage rate data from Freddie Mac coming out in the afternoon. Rates ticked up for the second week in a row on Thursday. It comes after 7 consecutive weeks of declines. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.